Hello to everyone listening to our podcast, The Active Investor with SGH. I'm Stephen Hiscock, Chair of SGH. Today's date is the 28th of February 2025. Today my guest is Matt Sgrizzi, the Chief Investment Officer of LaSalle Investment Management. I've known Matt almost since he started at LaSalle in 2002. Our partnership between SGH and LaSalle started in 2003, and we've built a really long and successful professional partnership with LaSalle, and Matt, obviously. And we've been delivering investment outcomes together since that date, 2003, offering Australian investors exposure to global REITs for over 20 years now. Today, Matt and I will be discussing global real estate investment trusts. And just to quickly define global real estate investment trusts, they are companies and trusts that own or operate in real estate around the world and are listed on major stock exchanges. We'll briefly look back at the last 12 months, and then more importantly, obviously, we're going to look forward to the next 12 months, looking at key themes, potential catalysts, danger signs, and so on. But before we start, please read the disclaimer provided in the episode description. So, good morning, Matt. It's great to see you again. And just to kick off the conversation, given that we've known you for 20 plus years, can you tell us a little bit about your professional journey, how you started your career in global listed property, what keeps you interested in global REITs, that sort of thing?
Well, it's great to be here, Steve. Thank you so much for those kind words and for the many, many years of fruitful partnership. It's winter in the Northeast US right now, so it's really nice to have a summer break here in Australia in February. Indeed, I've been with LaSalle for 23 years, it'll be this year. I'm a lifer. I started my career at LaSalle investing in global real estate companies. I actually started as an intern at LaSalle.
Amazing.
And even though I've been with the same company for a long time, I've really had many different roles in the company, actually covering companies all around the world, focusing on different areas and different markets over different periods of time. I was really fortunate enough to live abroad and work abroad with LaSalle. I lived in Amsterdam for 5 years, which was just a wonderful experience. I always provide guidance to young professionals to try their best to work abroad for a period of time.
Absolutely.
There's nothing like getting outside of your comfort zone and learning about the world, and it's a big global capital market, and understanding yourself and how the rest of the world works and is different from your home country, I think is really important.
Absolutely. And if you think about it, I mean, you've got an insight into European listed property that you really just can't get if you don't live in another country. If you live somewhere else, if you live overseas, you're just not going to understand the psyche that drives European real estate.
Totally. And sometimes I even say, I know from that period of time, I know what it means to be American, from a non-American perspective. And I think that's really valuable.
Yeah. Well, congratulations on your tenure. And also congratulations to you and the whole securities team, because you, and I better get this right, you are the best performing fund in the Australian Global Real Estate Morningstar category over the last 5 years. And that's a really incredible outcome. So congratulations on that. And look, I must, for full disclosure, say that I'm a very happy holder. It doesn't mean that this investment is right for everyone, but for me, your performance has been extraordinary. And so congratulations for that. So if we get down to LaSalle a little bit, you've grown a lot over the past 20 years. Can you tell us about the difference, I guess, between LaSalle and LaSalle Investment Management? Obviously, the whole group is owned by Jones Lang LaSalle. So can you just tie up for the listeners just how that all works?
Yeah, absolutely. So JLL, formerly known as Jones Lang LaSalle, we're now officially JLL, is one of the largest global real estate service providers on the planet. You will have seen our logo and our company offering services in commercial real estate anywhere in Australia. We have a very successful business here. And anything that you can do with a piece of real estate, JLL does it. They help leasing, they help sell it, they help tenants think about how they're using their space, they help design and build buildings across sectors and across the whole world. LaSalle Investment Management is the investment management arm of JLL, a wholly owned subsidiary of the company. And LaSalle is one of the largest and premier global real estate investment managers with about 90 billion US dollars of real estate equity under management.
Right. Goodness.
And we have grown an awful lot over the years. The company was born out of a series of mergers of a UK company and a US company, and has never looked back, growing globally over a long period of time. The LaSalle has 4 divisions, 3 regional private equity divisions, Americas, Europe, Asia Pacific, and our Global Solutions team, which I'm a part of. And Global Solutions invests in controlling interests in real estate around the world. And that's public securities, private funds, and co-investments. Right. And so that's a really great team to be a part of, because we're investing in companies, we're investing in our competitors' funds, we're doing deals with our own clients, our competitors' clients, some of the public companies, and we can take all of this information and pull it together to help make better informed decisions and have unrivaled market expertise.
Yeah, it must give you an extraordinary insight, Matt, because you've got offices effectively all around the world. You've got access to all markets from a domestic perspective.
Absolutely. We, about 900 people in LaSalle worldwide, in every place you want to be in the world. And I think a big part of my career actually at LaSalle has been about harnessing this platform that we have, all these fantastic resources to feed information directly into how we make investment decisions, especially for the securities group, but even more broadly across LaSalle. And everywhere I go in the world, I meet LaSalle folks, and I'm always super impressed. People care about their clients, they're focused on what they're doing, they're experts in their area of responsibility, and they want to help one another. We want to help one another. It's a real great collegial atmosphere in the firm, and we really use it to make ourselves better.
Oh, brilliant. I mean, certainly that's been borne out by the results over the past 5 years, Matt. So in terms of your investment approach, if we can look at that just briefly, you call it intrinsic value, which I'll ask you to define in a sec. It's a process that really resonates with me. So can you describe intrinsic value, what it actually means, and how it's different from, say, other people in the market?
Absolutely. So intrinsic value, I think the starting point philosophically in how we invest client capital in the public real estate markets is we have all this great information like we just talked about from the broader firm, but stock markets are moving around constantly. And it's not a good investment approach to just say, I'm going to take some information from somebody that's not responsible for an investment decision and use it because it was a nice thing that I heard. You've got to process all of this information in a holistic and comparable way and look at what the opportunities are that are actually available to you in the public equity markets and make decisions based on the price, essentially.
Yeah.
And that's what intrinsic value, when you take a step back, is all about, is identifying what we think these real estate companies are worth.
Yeah.
Right? And not just investing in momentum or going dumpster diving, but saying, putting all the pieces together and saying, I have this growth expectation, I have this risk expectation, I have this belief of what management is doing with this company, and I put all those pieces together and I say, here's what I think this company is worth, and I compare it to what I think all the other companies are worth, and I look for attractive value on that basis.
And I mean, the fund itself is what we define as high conviction. It's generally sort of 10, 15, 20 stocks. What's the thinking behind that? And for some people that might sound like not a lot. Can you just explain your theory there?
Yeah, really 5, 6, 7 years ago, in partnership with you all, Steve, and your team, I think I would say particularly in Australia, that we were seeing that when investors want to go active, they want to really go active.
Yeah.
And particularly for a sector like real estate, which I wish that investors would have 50% of their portfolio invested in real estate, but I understand that they don't. Yeah. They're usually allocating 5, 10, 15% to the sector. And if they're going active, they want to be active. And so we wanted to meet the market there. And we wanted to prove that what we're doing works and lean into it. Really simple. What we do is we take these great resources. I'm fortunate enough to lead an extremely experienced talented team of investment professionals in our securities group, and we assess the world of real estate opportunities, and we only invest in the best 10 to 20 ideas that we can find around the world. That's it.
Well, it resonates with investors. I mean, thank you for fitting us in today, because yesterday I couldn't even see you because you had back-to-back meetings from sort of 8 a.m. to 8 p.m. and I think it's the same today, so thank you.
Well, look, I have to say, every time I come to Australia, the meetings are so good. Right. Your average advisor in Australia is as tuned in and adept at understanding real estate markets and capital markets as a institutional consultant, I would say, in other parts of the world. So there's a lot of really switched on people in the financial industry here. So I love it. It's really a great challenge every time I come here.
And there's a great familiarity with REITs. The domestic REIT market like Westfield and Stockland and GPT has been around for a long time. And so it's a natural extension to look at the global equivalents. And you're right, the planning community, some of them are mini consultants effectively. Certainly, I'm not surprised you're seeing that. Okay, well, let's get down to some details now. Let's start with the overall sector. How has the global REIT sector gone over the last 12 months?
It's been a lot of back and forth, Steve. Concerns about inflation and what that means for interest rates and broader levels of financial conditions have been in the driver's seat. And it's been this back and forth debate about inflation, if it's settling down, if it's picking back up, if we're on the brink of a recession, if we're on the brink of the economy completely taking off, new political concerns everywhere around the world. And so it's been a lot of back and forth essentially. And we've been kind of moving sideways as a group, along with the equity market over the past 12 months or so. But we think that's really an opportunity in our sector, especially because in the past 12 months and even before that, broader equities have gotten really extended on a valuation basis. Yeah. And these concerns about inflation and interest rates really weighed on the real estate sector on a relative basis. And we think that the risks are far more balanced. This is playing out, I think, here just over the past couple of weeks, really. There's just so many great opportunities out in the capital markets, companies, great sectors that have been a little bit forgotten about in the midst of all of this, hand-wringing. We think that the outlook is a lot more supportive for real estate than the market's giving credit for.
So the interest rate side, which you mentioned, most of our readers will be very familiar with the close correlation between lower interest rates and solidly performing REIT markets. But could you just explain why that happens for those that have got more interest in it?
Yeah, so real estate truly is a unique asset class. And what that means is that it's different from stocks and bonds. And it's because the intrinsic driver of real estate values is a little bit like bonds because it has a strong income component to the total return. And it's a little bit like equities because it's a perpetuity, it provides inflation protection, it's a very long-lived asset. So it sits neatly between the two. But interest rates affect the value of bonds directly. You don't get any growth. But there is also the growth side of the real estate return. And that's what I'm kind of referring to when I say that there's opportunities in the real estate market and the sector's been beaten up unfairly because there is great growth in the sector as well. It's not a bond, a little bit of both. Yeah. And so that is where I think the market is overlooking some of these great cash flowing properties and businesses and the growth potential in those businesses.
And we'll talk a little bit more about sectors and so forth, but just something that's been interesting me. Has there been much corporate activity as a result of this in recent times?
Yeah, it's picking back up a little bit here. Right. So because the sector's lagged a little bit and because we're seeing private equity, capital formation is really taking place. So a lot of those big private equity firms are raising money. Their stock prices are up a lot. They expect a good M&A environment. Yeah. They're looking to deploy capital and they're looking at public companies. And in fact, Blackstone, who's the largest real estate investor in the world, acquired 2 U.S. REITs last year at significant premiums to the stock price.
Right, okay.
And actually we had both of those companies are concentrated in the fund.
Oh, well done.
And really benefited from that. And then just a couple days ago, Blackstone's infrastructure fund bought out 20% of the assets of another one of our holdings in the fund.
Okay.
They bought a portfolio of, very interestingly, marinas.
Really? Marinas? Wow.
Yes, from one of our companies.
Okay.
So things are picking up, and that's, I think, a key point. It's a great question because not only do I expect REITs to deliver really attractive returns on an absolute basis relative to some extended areas of the equity market, but if it doesn't come through, then other sources of capital are going to arbitrage that and eventually benefit us.
Exactly. They're going to find it for you.
Exactly.
So, look, at the end of the day, aside from corporate action, global REITs represent, effectively the underlying exposure is real estate. The performance of real estate markets is critical, and the future outlook for real estate markets is critical. I guess I'm asking you a 7-hour question here and asking you to put it into about 2 minutes, but could you just run through the major property sectors, retail, office, industrial, triple nets and so on, how they're positioned in the US and what their outlook is going forward?
Of course. So overall, real estate fundamentals are quite healthy today. We have all this access to information. We do bottom-up analysis of the companies and their real estate portfolios and project out how we think their cash flows are going to grow. And we have a very healthy growth expectation for the sector over the next couple of years. In fact, it's actually double the long-term average of growth expectations. 4% growth per year, unlevered.
So that's better than GDP forecast a fair bit.
And better than, the long term's been 2%, close to inflation essentially. Okay. Yeah. That's where the real estate being an inflation hedge comes from, essentially, is that the cash flows grow. So very healthy environment overall. There are outliers on both sides, of course, but the really strong growth sectors right now are clearly data centers, which we could talk for 3 hours about that market, and the healthcare sector, which is enjoying kind of a multi-level drivers of far better fundamentals for that sector. But there's also retail is doing pretty good. After being in the doldrums from the e-commerce headwinds for many years, retail's in great shape again. The office market's coming back, believe it or not. Right. Especially higher quality office buildings are seeing rents increase and are effectively
the occupancy side, really, they're full.
They're full. If you want to lease space in a good part of a major world city, in a new building that's amenitized, has good public transport links, the landlord has maintained the building well, it's a good quality building, you literally can't find space.
Right.
And if you can, the rent is going up as we speak.
Wow. Well, that's interesting for Australia. That really hasn't happened yet in Australia, but in some time, it's possible, obviously, that the office markets will follow suit here. Obviously there's a lot going on in the US. It's such an important market though. What about Europe and the UK? How are you seeing things over there?
The economic environment is more subdued in Europe. It is. And I think probably more importantly even is the European property companies are more focused on the traditional property types like office, retail, industrial, residential. The one big driver of the success of REITs more recently, and I would say more particularly in the US, has been exposure to these new niche, more operationally intensive types of sectors like healthcare, like data centers, self-storage, cell towers, triple net lease, you name it. There's all these other sectors out there that particularly companies in the US are real leaders. They're a little bit less available in Europe, so it's not as much about the economies of the regions as it is more about the sectors. So data centers in Europe are really strong because they're data centers.
Yeah, and you see them popping up all over Europe.
Indeed.
And some of them are huge.
Oh yeah, and I think it's okay to talk about an investment that we have in a Spanish company that is developing data centers. Right. And we really like that because Europe is building out their data center capacity. The EU is the second largest economy in the world in aggregate, and Spain has an excess of renewable energy, solar and hydropower, and you can lease a data center in Spain and potentially have it powered completely by renewable energy, which is a wonderful offering in a global context. And so things like that we're finding those kinds of opportunities in the market that are really exciting.
Right. Well, that's brilliant. So it's interesting you say that, because the conventional wisdom is that Europe, and to a lesser extent perhaps UK, are moribund from an economic perspective, but it still means that, particularly for a high conviction stock picker, there are sectors that are growing well above the economic growth side.
Yeah, and coming back to what we talked about earlier, there's a lot of extreme valuation differentials in the market today because of this, obsession with growth and technology-oriented companies. And again, having lived there for a number of years, there's good companies in Europe, there's good property in Europe, and it's been kind of left for dead to some extent. And so that's a great place to take the other side of the argument and find some opportunities.
Well, and that's where your intrinsic value process is so disciplined. Are there any other regions that look good to you? I remember, was it last year or the year before, you were in Japan and you did really well out of that. Are there regions other than Europe and so forth that you're looking at?
Yeah, Canada is also an interesting market to us as well. The Canadian REITs have been under a little bit of pressure as well because of the same kind of dynamics that have weighed on Europe. And so just kind of, again, that it's not U.S. tech. There's U.S. tech and there's everything else in the world essentially today. And we're seeing some particularly attractive value for some companies in Canada. We can play some themes that we like in the U.S. or globally at much more attractive levels of valuation through Canadian REITs. Right. For example, today we really like the healthcare sector, but we can get access to it, these great fundamentals, at a much better price through Canadian company,
right,
for example. And we did have a very big position in Japan that worked extremely well last year. We did kind of move on from that, actually. We still have some positions there, but we've downscaled that after some great calls in that market. We're seeing Japanese companies step up to the plate, to use the American sports analogy, to improve themselves.
And that's a huge change.
Huge change.
Yeah.
And as investors looking for those kinds of shifts in the market and predicting, that's something that we've really liked. And we saw the market kind of come to us on that last year.
Okay, well, brilliant. So back to the sector as a whole, using your intrinsic value methodology, is the sector trading below net asset value? And I guess a separate question is, what's the portfolio trading relative to net asset value?
So again, big dispersions in the market today. So we see REITs overall as trading around our intrinsic value, around fair value. Okay. And that's great, actually, because that means REITs are priced to deliver high single-digit returns on kind of a forever basis, which is what REITs have actually done over the past 25, 30 years, and what you should expect from moderately leveraged core plus real estate, high single-digit returns, safe investments, good levels of income, 4 to 5% levels of income return. That's what's on the tin, what the sector is supposed to do. That's what it's priced to do today. But underneath that, there's a lot of companies that look fairly expensive to us, and a lot of companies that look really attractive to us. And so we've tilted our portfolio towards those more attractive companies, and our portfolio is at a quite considerable discount to that breakup net asset value or our intrinsic value. And because of that, we expect a higher return from our portfolio over time, much higher.
And to be fair, that's exactly what we've seen over the past 5 years in terms of your portfolio. So there's obviously plenty of opportunities out there. Just in a general sense though, how is policy uncertainty or perhaps policy volatility in the US affecting global REITs?
It's an issue. It's a factor today. I think the world economy stopped with COVID for 3 months, which never happened before in the history.
For 3 months or 3 years?
For 3 months, it literally stopped completely.
That's right.
And then governments around the world, central banks threw money at the problem, and it was too much money. That created a lot of inflation, and then they pulled that money back, and that has brought a very nice, I should say, level of disinflation. That's been a very powerful trend of disinflation. And now we're worried about policy changes potentially bringing in some level, renewed upward pressure on inflation. I would say we see the risks as more balanced. And again, this comes back to the big differentials in valuations that we see around the world, the market had kind of gone all in on this being the case in one direction. But a lot of policy uncertainty, that's not good for the economy. No. That's not inflationary, that's deflationary ultimately, right? And I think we don't see a renewed, unbelievable amount of money printing on the horizon. That is not in the cards. But what overwhelms the level of interest rates is always the business cycle. Yeah. And if the business cycle is cooling off a little bit, which I think is fair to say, we've had a great run in the global economy over the past several years. It would be nice to have a nice soft landing. I think that's the baseline expectation. That's what we expect. But it's very rare to accelerate further after a run like that. And so I think that that's the most important driver from here. And, I would just tell investors to try to put your phone down and not read every single headline and get yourself worked up about that, because problems will be created and solved and created again in the same day. And you need to focus on the fundamentals and focus on the opportunities that maybe overreactions could be offering investors.
Yeah, and it goes back to the fact that the equity markets have predicted probably 70 of the last 3 crashes. So it is volatile, far more volatile than the underlying economy. I'm going to put you on the spot with some of the sectors. So data centers you've spoken about. Can you define what a data center is and then talk just briefly about DeepSeek?
Sure. A data center is actually really simple. It's landlords sell power to their tenants and through a building. That's really all it is, actually. They are large warehouses, industrial-looking facilities. They're getting a lot cooler looking nowadays, but you don't have a data center unless you have power. And that's really what the product is. You get power to a site, you construct a building, and lease it to a tenant to use the facility for whatever data center purpose that they have, and there's many. I'd say there's kind of 2 broad types of data centers. One, which is what you would typically think of as a hyperscale data center that will be in a more suburban type of location, maybe a little bit better access to power, and usually it has 1 or 2 tenants in the building. And it'll be household names, Google, Facebook, Amazon, Microsoft, leasing that space and using that data center to serve their clients. And then there's network dense data centers. And that is more like a virtual city to think of. So those are data centers that are usually closer to people, so more infill locations, usually more on top of the fiber infrastructure, and there'll be many tenants in one building, in one data center. And the beauty there is that a lot of internet activity actually happens just within that data center. So it's something like 40% of internet activity is between a couple of those same companies,
in
right?
the same building.
In the same building,
in the
same buildings around the world. And so that's actually, for a landlord, it's a really nice little business. If you've got Amazon, Google, Facebook, Microsoft all in the same building, and then you can say, okay, I'm gonna plug you into each other right here in the building, but I'm gonna charge you rent for that wire. That's called interconnection. That's the business of a network dense data center. And why is everybody there? Because that's where everybody is.
And it's speed. I mean, we're talking speed of light, but it is faster. It's infinitesimally faster.
It is, and that really matters. People, and I think increasingly so, that if you open up your phone and you want to go on Amazon and you want to buy something and it's not loading quickly, if there's a lag, you might not buy something. You might move on to another website or forget about it. That's not what these companies are in the business of providing.
No, you're right. DeepSeek?
So DeepSeek shot across the bow of these highly valued companies, I would say, technology companies around the world. I think it's not unfair to say we need to understand exactly what DeepSeek is claiming that they can do, which is produce excellent results at a fraction of the cost for other large language models. We need to verify what they're saying. So that is still out there. But really, I think the bottom line, the takeaway for us from DeepSeek is the price that you pay for high growth matters.
Yeah, absolutely.
And if you expect earnings growth to be 100% over the next couple of years and you're paying 100 times earnings on those and then you get one little wiggle in the
Yeah.
growth, then all of a sudden that can push back on valuations. And I think that if DeepSeek's true or not, I think the message is certain actually, which is that there's a lot of capital, there's a lot of competition, there's a lot of eyeballs on AI, and this stuff is going to get better, and it's going to be democratized.
And I guess what it means is there's possibly more demand for additional demand space for these places. Over the years, there's other really super interesting sectors. There's prison REITs, there's billboard REITs. I mean, what is a billboard REIT? Literally just something that owns billboards.
That's what it is, indeed.
Wow.
It's actually a really nice little business.
I mean, clearly that's the US. Is it? Is it the US or is it European as well?
There are companies that own billboards in other parts of the world. The REITs that we generally follow are more US focused.
Okay. Any other emerging sectors that take your fancy at the moment?
You know, there's always something new. I think a key consideration is that investing in real estate in private equity markets is one thing. A lot of the really exciting and dynamic and new and cutting edge concepts that become available to investors in the property markets often come in the public markets.
Right.
And I think that this is an enduring trend because these sectors are a little bit more operationally intensive. They lend themselves to perpetually going concerns like a public company.
Yeah, absolutely.
So I think we've seen this kind of intensify over time, and I think that it will endure because of that basic concept. But you know, if it's self-storage or holiday homes or new types of retail formats like outlets or unanchored daily use retail that's in fantastic locations, we're seeing companies play around with those formats and focus on them increasingly in the public space. And there's always something new out there.
How interesting. I mean, it must make life fun for you. Okay, back to the overall picture. The outlook for the next 12 months, you've said that the sector's roughly trading at fair value and your fund is trading below fair value. So you're talking single digits, early double digits for the fund perhaps?
Yeah, we see the REIT market delivering that high single digit, 8 to 10%, call it return. Again, that's great. By the way, little history lesson real quick. Over the past 25 years, REITs have done 9% annualized returns.
Right.
You know what equities have done?
9?
6. You know what happened 25 years ago? The tech bubble.
That's actually really interesting, isn't it?
It sure is. The price you pay for growth matters.
Yeah, it does. That's right.
And so we expect about that, but we do expect a lot more from our portfolio. We expect into the teens.
Okay,
From our
fantastic.
portfolio. And that's what we've been delivering, a return that's been, 600 to 800 basis points above the index.
So in terms of the fund, what are the major sector exposures? I know you don't look at the sectors so much as themes and so forth, but what are your major regional exposures and sectoral exposures at the moment?
So we are invested in many parts of the world. The US is a big part of the REIT market overall. We have a little bit less exposure than our peers or the index in the US, and a little bit more in Europe and Canada.
Okay.
And so those are, again, some of the main exposures that we have. But by property type, we have really great diversification. So each property type, that the way we see the markets, really have unique supply and demand characteristics, and that provides excellent diversification to the portfolio. So even though we're highly concentrated, we have a diverse portfolio, and the risk profile of the portfolio is very neutral, essentially. And some of the sectors where we've got great residential formats in the portfolio, we really like cell towers, which we could talk about for a long time, different retail formats. We've actually added office back to the portfolio about a year ago. We were completely out of the office market, and the tide turning there, and it was a material underperformer compared to other REITs. And the list goes on for other sectors.
Well, okay, fantastic. And look, I'm going to put you on the spot now and ask you to talk about a couple of major positions in the portfolio. And just to remind the listeners, this information is correct as at 28th of February 2025. And it's not advice, but Matt's just going to describe a couple of major positions in his portfolio as we sit today.
Yeah, so I think I touched on it briefly before. I think it's quite notable, this holiday home company that we added to the portfolio just a couple of weeks ago, selling a large portion of their assets to Blackstone. is really interesting. This is a company that had gotten a little bit over diversified in their portfolios, notwithstanding the core sector exposure that they have of these manufactured home, holiday home parks.
What's his name?
Sun Communities.
Okay,
Sun
yep,
Communities.
absolutely.
Great business, the manufactured home sector.
And it's been around for a long, long time.
A real long time, and incredible track record of growth, low expenses to maintain the properties, really great business, but the company had kind of lost their way, and now they've made this asset sale, and all of a sudden, investors can see a simplified story, management getting serious about cleaning up the company, focusing it, right? So big improvement there. We have a significant investment in the cold storage sector. Right. That's another interesting sector.
It's a REIT that just owns fridges.
That's right. That's right. And that's an industry that has had a tough go of things over the past couple of years.
Okay.
And we see just incredibly overly discounted valuation. And in fact, that company reported earnings the other day far better than feared, and the stock is performing quite well.
And sorry, just for my own education, these are REITs that presumably lease to Walmart or some food company for a long period of time. Is that right? Or?
It's interesting. So the cold storage business is quite operationally intensive, and they lease to predominantly, they could lease to grocers, but a lot of it is to the food manufacturers actually.
Okay.
So you may have heard of Tyson, which is the largest producer of chickens. And they have space in Americold's cold storage facilities, but Americold manages their inventory for them in the building.
Okay, so this is Americold.
This is the name of the company that we're invested in. And it's a really cool business. I've toured some of these properties. They're really cold.
In a parka.
You literally have to put a parka on, a full body parka in some of these things, and you can only stay in for a couple of minutes.
Oh my goodness.
And it's very interesting. And I mean, some of these facilities, they're the lifeblood of how we live our lives every day, and you don't even think about it, right? But this is where our food comes from.
Oh, and how fabulous that investors like us, normal everyday investors, can get exposure to these things. These things are, potentially hundreds of millions of dollars in value, but we can get fractionalized ownership through global REITs. Matt, I could talk to you for hours, but I'm conscious you've got to go to a meeting in about 5 minutes. Thank you very much for your efforts over the past few years. It's been terrific to see you again. We always look forward to you coming back down to Australia, and we do find it unusual that you come in the American winter. Congratulations on your performance. Thank you so much for your insights. And that brings us to the end of today's podcast. We've looked at the market, what it's done over the past 12 months. We've looked forward. We've spoken a little bit about the SGH LaSalle Concentrated Global Fund, the fund that Matt and the team run. If you are interested in the fund or you have any questions, please contact our distribution team. Their details are on the website. We hope you enjoyed today's episode. Please subscribe so you don't miss out on future podcasts, and follow us on LinkedIn. And until next time, stay informed and stay active. Equity Trustees is a responsible entity for the funds mentioned in this podcast. This podcast has been prepared by SGH to provide general information only and is not intended to take the place of professional advice. It does not take into account the investment objectives, financial situation, or particular needs of any particular person. Neither SGH, Equity Trustees, nor any of its related parties provide any warranty of accuracy. Past performance should not be taken as an indicator of future performance, and you should obtain a copy of the product disclosure statement and seek independent advice before making investment decisions.